For the first quarter of 2026, ACEN Corporation reported a headline 50% year-over-year surge in net income, reaching 2.9 billion pesos. Across the retail market and mainstream financial press, that top-line number triggered immediate optimism. Investors saw a green arrow and assumed the company transitioned into a higher tier of profitability. But reading a press release is different from reading a balance sheet. We have to ask if this represents a sustainable operational boom or a temporary accounting mirage. Today, we are going to dissect the data behind ACEN's race to a 20-gigawatt renewable energy capacity by 2030. We are going to apply the operator approach, ignoring the noise, discarding the press release, and analyzing the raw underlying numbers. Because navigating the global renewable energy supercycle requires the ability to separate one-off accounting windfalls from actual recurring cash-generating power. Before we analyze the financials, we need to establish the geographical scale of ACEN's current operations, which span both the Philippines and international markets. The company has secured operational wins. Domestically, their wind assets in Ilocos Norte have recovered from previous disruptions and returned to near full capacity. Internationally, new projects are beginning to contribute to the grid, with wind and solar assets scaling up in Lao PDR and Australia. This expansion yielded a clear data point. Total attributable renewable energy output increased by 32% this quarter, reaching 2,230 gigawatt-hours. However, a surge in physical gigawatt output does not automatically translate to a surge in core bottom-line profit. Physical generation is only step one. Financial structuring dictates whether retail investors will see those gigawatt gains reflected in core earnings. To understand the performance, we need to perform a financial autopsy on that reported 2.9 billion peso net income. This waterfall chart allows us to strip away the accounting noise. First, we deduct a primary anomaly, a 1.75 billion peso recovery from a Manila Electric Company power supply agreement. This recovery was a change in circumstance claim approved by regulators to cover incremental fuel costs from the 2022 coal price spikes. It is a backward-looking fix rather than recurring future revenue. Next, we deduct a 1.4 billion peso gain from the consolidation of ACEN's India joint venture platform. While taking full ownership in India secures a significant development pipeline, this specific 1.4 billion is a paper remeasurement gain. It represents accounting goodwill, not physical cash flow. We then add back an offsetting negative anomaly, a 1.2 billion peso impairment provision triggered by revised payment practices from Vietnam's state-owned utility. Once we account for these one-off items, you're left with the final result: core net income of 1.4 billion pesos. The reality is that core earnings did not surge 50%. They fell 27% year-over-year. Trading on a headline net income without checking the footnotes for non-recurring gains can lead to an inaccurate view of the company's growth. To understand why core profits fell while energy generation rose, we have to look at the carry cost of rapid scaling. This dual-axis chart illustrates the situation. Generation output is trending upwards, but core net income is moving down. That shaded area between them is the carry cost. There are two specific financial friction points creating this gap: rising depreciation and higher interest expenses. As massive solar and wind projects finish construction and go online, heavy depreciation charges hit the income statement. Simultaneously, funding a regional build-out through debt drawdowns drives up interest expenses. These expenses are largely unavoidable when building infrastructure at a multi-gigawatt scale. A 27% drop in core profit represents the financial friction required to scale infrastructure at this speed. Shifting from past earnings to the future pipeline, ACEN has set a capital expenditure budget for 2026 of over 80 billion pesos. Looking at the geographical allocation, roughly 70% of that capital, nearly 60 billion pesos, is earmarked for the Philippines. This local spending is concentrated on physical infrastructure, completing solar farms, advancing wind projects, and deploying battery energy storage systems. Battery energy storage systems, or BESS, are a strategic priority for the company. During daylight hours, solar farms can oversupply the network. Best technology allows ACEN to capture that excess and dispatch power during peak evening hours when the sun goes down and prices are highest. Every peso of this local spending ties back to the corporate target of hitting 20 gigawatts of total capacity by the end of the decade. By front-loading 60 billion pesos domestically, ACEN is attempting to corner the government's green energy auction program and build a significant competitive advantage. Overseas, Australia has established itself as ACEN's second-largest market and a primary international growth engine. Generation in Australia surged by 87% this quarter, driven by better solar irradiance and more efficient management of grid curtailment. A primary driver of this recent quarterly success is the 400-megawatt Stubbo Solar project in New South Wales. The shift occurred when ACEN folded the Stubbo Solar project into a 750 million Australian dollar non-recourse portfolio debt facility. This non-recourse structure means the debt is secured only by the specific project's cash flows, protecting the parent company's balance sheet while freeing up capital for new pipeline projects. Securing this backing from 11 leading Australian and international financial institutions underscores significant market confidence in their execution. Mastering this type of international project finance allows the company to scale globally without overextending its core balance sheet. This brings a critical question for retail traders. How does a company fund an 80 billion peso capex pipeline without diluting current shareholder value? Look at ACEN's decision to pause a planned 30 billion peso stock rights offering. There is a common view that fast-growing, capital-intensive companies must constantly issue new shares to fund their expansion. Pausing the rights offer signals management confidence in their internal cash reserves and their ability to maintain a 70-30 debt-to-equity structure. While statutory net debt has risen to 158.3 billion pesos, the consolidated net debt-to-equity ratio remains around 0.90x, which is within safe covenant limits. Management is signaling that issuing new shares should only happen when capital can be deployed instantly for returns, rather than just to increase cash on hand. This level of capital discipline is a strong indicator of a protective management team. To finalize the trade thesis, we apply the Alpha Protocol framework. We strip away the reported profit gains and focus on raw cash generation capability. Despite the heavy carry costs dragging down net income,